Topic explains how firms determine whether to continue operating, temporarily shut down, or permanently exit a market under varying cost and revenue conditions. The topic begins by distinguishing between the short run and the long run. In the short run, some production factors, especially capital such as buildings and machinery, are fixed, while variable inputs can still be adjusted. In the long run, all costs become variable because firms can alter plant size, terminate leases, or sell equipment. This distinction is fundamental because shutdown decisions differ depending on whether fixed costs remain unavoidable. The analysis applies to both perfect and imperfect competition structures. The concept of break-even is central to understanding firm profitability. A firm reaches its break-even point when total revenue equals total cost, meaning economic profit is zero. Under perfect competition, this occurs when price equals average total cost. At this level, the firm covers all explicit and implicit costs but earns no excess return. If price rises above average total cost, the firm earns positive economic profit. If price falls below it, the firm incurs losses. Break-even analysis helps managers assess whether continued production creates value and allows analysts to interpret industry dynamics, especially in highly competitive markets where long-run economic profits tend toward zero because of free entry and exit. The topic also emphasizes the importance of the shutdown point in the short run. Because fixed costs must still be paid even when production stops, a firm may continue operating despite losses if revenue covers variable costs. The key decision rule is whether average revenue exceeds average variable cost. If price or revenue remains above average variable cost, the firm can contribute something toward fixed costs and reduce losses by staying open. However, if average revenue falls below average variable cost, operating losses become larger than fixed costs alone, making shutdown the preferred option. This short-run shutdown rule is especially important in cyclical industries where temporary declines in demand may not justify permanent market exit. Under imperfect competition, firms face downward-sloping demand curves, meaning marginal revenue no longer equals price. As a result, break-even and shutdown analysis is more effectively performed using total revenue and total cost relationships rather than relying solely on price comparisons. The topic identifies three critical conditions. Total revenue equal to total cost indicates break-even. Total revenue greater than total variable cost but below total cost implies the firm should continue in the short run but eventually exit in the long run. And total revenue below total variable cost signals immediate shutdown. These principles apply to monopolistic competition, oligopoly, and monopoly structures. The framework helps analysts understand how pricing power and demand conditions influence survival decisions across industries with varying competitive intensity. The discussion of economies and diseconomies of scale focuses on long-run cost behavior. Economies of scale occur when increasing production lowers average total cost because fixed costs are spread over more units or operational efficiencies improve. This creates the downward-sloping portion of the long-run average total cost curve. Common sources include specialization, technological efficiency, and purchasing advantages. However, beyond a certain output level, diseconomies of scale emerge as coordination difficulties, bureaucracy, communication breakdowns, and management inefficiencies increase costs. The long-run average total cost curve therefore becomes U-shaped, with the minimum point representing the most efficient scale of operation. Understanding this relationship is critical for evaluating firm growth strategies and industry competitiveness. Overall, topic provides a foundational framework for analyzing firm behavior under different market conditions. Investors and financial analysts use break-even and shutdown concepts to evaluate a company's operational resilience, pricing flexibility, and long-term viability. Firms operating below average total cost for extended periods may struggle to survive unless they can improve efficiency or increase revenue. Meanwhile, scale economies can create competitive advantages by lowering production costs and supporting profitability. The topic also highlights how market structure affects strategic decisions, particularly regarding production, pricing, and expansion. By combining cost analysis with market dynamics, the topic equips CFA candidates with practical tools for assessing corporate performance and industry sustainability.